Hello learners, welcome to C.A.S.H. In this video, we will learn how to prepare a ledger. If journal is the recording stage, then ledger is the clarifying stage. It is the book of final accounts where we open one separate account for each items. That's why it is called principal book of accounts. Every ledger will have two sides, that is debit and credit. In debit portion, we have date, particulars and amount, and in credit portion also we have date, particulars and amount. So this set is called a ledger. Debit side always uses the word to, credit side always uses the word by. Why we call it as a principal book of accounts? Because final accounts, that is P&L balance sheets, are prepared using ledgers, not directly from journal entries. Journal entries records transaction date-wise, but ledger group those transaction account-wise. These are the journal entries we have passed from the transaction. Now, if I ask what is the bank balance from these entries, then you will have to calculate each and every entry, like 1,90,000 minus 40,000 minus 1 lakh, like this. But in ledger, we group all the transactions related to bank account. With this, we can directly find what is the closing balance. So for this purpose, we are preparing ledgers. So with this concept, let's prepare ledgers. The first journal entry was cash account to capital account. We have date, particulars, amount. It was cash account debited to capital account. Don't think that this capital account is debited. Cash account debited to capital account. Now, two accounts got affected. One is cash account and capital account. Since it is double entry system, we have given effect to cash account. But what about capital account? Capital account is giving money. In cash account perspective, it is receiving money from capital account. Capital account is giving money to cash account. That means cash account is receiving money from capital account. So the golden rules again applied. Debit what comes in, credit what goes out. The next entry was bank account debit to cash account, rupees 1,90,000. It means cash deposited to bank. Cash is giving money to bank account. If you observe, we have just grouped the transaction of one single account. Cash is an asset. The real account rule will apply. Debit what comes in, credit what goes out. Cash comes in, cash goes out. Everything posted here is related to cash account. If you observe, the journal entry didn't say balance carried down. Then why it is here? This is the balance available with this account as on balance sheet date. 2 lakh you collected from capital and you deposited 1,90,000 to bank. So in cash account, you have 10,000 balance. Like we did for cash account, we have to prepare ledgers for all the accounts separately. With that, we can prepare trial balance, P&L and balance sheet. Next, shop rent advance account debit to bank account, rupees 40,000 on 1/4/2025. So to bank account, because we are paying money through bank. So on 1/4/2025, money paid to shop rent advance, rupees 40,000. Purchase account debit to big mobiles account. We have purchased mobiles for rupees 2,50,000 on 20th/4/2025. Debit all expenses and losses. So purchase account debit to big mobiles account. Since no purchase has been made till balance sheet date, the total purchase account will be sent to trading account. Now we have to make entry for big mobiles account. Since big mobiles account is giving credit the giver, and to which account it is giving to purchase account, rupees 2,50,000. So the next entry says we paid rupees 1 lakh to Big Mobile's account. So Big Mobile's account debit to bank account. Big Mobile account is receiving money, so it says debit the receiver. So to bank account 1 lakh on this date. Now we have to treat the same entry in bank account. Bank account credit, because credit what goes out. We are paying to Big Mobile's account, money goes out. Then rent expenses debit to bank account. Rent paid, money goes out. Since it is an expense, debit all expenses and losses, and the same happened for every month end. So the total will be 24,000. Since it is an expense, all income and expenses will be sent to P&L account for profit or loss calculation. So we are sending it to P&L account. P&L account is debited, rent expense is credited. Now it is rent expense account debit to bank account. Then it will be profit and loss account debit to rent expense account. So in both the journal entries, common thing is rent expense account. So if we cancel this same account, the leftover is P&L account debit to bank account. Next one is bank account debit to bank loan account. You have taken loan from bank. Bank loan is the giver, credit the giver. So it is giving money to bank account 1,20,000. It will be debit the receiver. So it is receiving amount from bank account. So from this you may observe that which account we are preparing will receive money from debit side. Which account we are preparing will give money to credit side. Next one will computer account debit, printer account debit to bank account. Here we are debiting two accounts, but we prepare ledger for separate account individually. Debit what comes in, so debited. The balance will be carried down to next period. For printer account also, debit what comes in. It is receiving money from bank account. There is no adjustment and it will be carried down to next period. In bank account ledger, credit what goes out. It is giving money to computer and printer account. So both are entered in credit side. Next one is sales made and amount received. Bank account debit to sales account. Sales account we opened. Credit all incomes and gains. Bank is receiving money from sales account, so entered in credit side. Debit what comes in from sales account, money comes in. Interest expense account debit to bank loan account. Interest has been charged by bank loan account. Bank loan account is the loan giver. He charge interest, so credit the giver. Interest expense account charged by bank loan account. Debit all expenses and losses. Again in next month it will charge 908 as interest. So the total interest as on balance sheet date will be 1908. So that will be sent to P&L account, which means we are charging this total amount to P&L account. Since it is an expense, we will take it to calculate the profit and loss of that particular year. After that we paid installment for bank loan, so that will be debit the receiver. Bank account is the giver, credit what goes out. Bank loan we are paying 11,000. So we made sales to Slim Mobile LLP. Credit all incomes and gains. Sales account credited. Debit the receiver. Slim Mobile's account is receiving. Because of sales, the amount raised. So sales account entered in debit side. Then we received money from Slim Mobile's account. Slim Mobile's account is giving money to bank account. So credit the giver. Debit what comes in. Money is coming to bank account and the giver is Slim Mobile's account. We are again paying to Big Mobile's account rupees 1 lakh. Debit the receiver. Credit what goes out. Bank is giving money to Big Mobile's account rupees 1 lakh. And the rest is same as we did in previous transaction. For asset and expenses, total the debit side first. Normally the debit side will be higher. For liabilities and incomes, total the credit side first. For this, normally credit side will be higher. So if you take cash account, 2 lakh is the debit and 1,90,000 is the credit. So balance is 10,000. So with that concept, if you find out the closing balance of the ledger, then you can prepare trial balance. So the trial balance will look like this. It will contain all the final balance of the ledger. Here also all the debit and credit should match. If your trial balance matched, then you can move on to trading and P&L account. The highlighted part is called trading account and the below part is P&L account. Why we call this part as trading account? Because transaction related to trading only happens here. Transactions related to not trading but related to business will happen here. So that's why it's called trading and P&L account. Here we take total amount instead of taking individual amount. With this we can calculate what is the net profit or loss for the given period. So this is the opening stock which was brought down from the previous period, and this is the closing stock which will be carried down for the next period. Since it is a new business, we don't have any opening stock, but there is a closing stock. Let's find how this closing stock arrived. Cost of one unit is 5,000. We have purchased 50 units. So 50 into 5,000 is equal to 2,50,000. We sold 15 units. Cost of 15 units will be 75,000. We have stock worth of 1,75,000 as on balance sheet date. But we sold these 15 units for total 97,500. Since the cost of goods sold was 75,000, the difference is our profit. The same is recorded here. This is the closing stock as on 30th June 2025, that is on balance sheet date. Since this is the profit because of trading, so we call it as gross profit. We adjust income and expenses which are not related to trading, then we will calculate net profit or loss. Since it is a profit, credit all incomes and gains. This is the total rental expenses paid and this is the total interest expenses paid. We show the balance as loss. It is also called excess of expenses over income. That means we have made more expenses than our income. Here also total debit should match with total credit. So this is all about trading and profit and loss account. The last statement of accounts is balance sheet. This is the snapshot of business. Here we record liabilities and assets. In balance sheet, you won't see debit and credit, but by default, always keep in mind, assets show debit balance and liabilities shows credit balance. Let's see how these numbers arrived here. If you look at trial balance, we have already treated purchase account, rent expenses account, interest expense account, sales account. Let's mark these accounts so there will be no confusions whether to take again or not. So what is left has to be taken in balance sheet. So let's start from capital. Capital we have 2 lakh here. In P&L account it is showing net loss. So this loss means the company is simply saying I won't pay this amount forever. What does it mean? Owner gave capital of 2 lakh, but company is in loss of 3,408. That means company is directly telling to the owner that if you close the business as on 30th June 2025, that is on balance sheet date, I will only return you this amount. So that is what reflected here. That is why the state of balance sheet is very important. It may earn profit or it may make more loss. If owner closes this business as on this date, the business will return the owner's amount only this much. After adjusting net loss, the capital account ledger looks like this. Credit the giver, capital give cash, net loss during this period 3,408. So the balance payable to the owner is 1,96,592. Now let's move on to bank loan account. we have to pay 1 lakh as per ledger. So the bank loan account payable is 1 lakh. Next is current liabilities. That is Sentry Creditors Big Mobiles account. We have to still pay 50,000 rupees to Big Mobiles, 50,000 payables to Big Mobiles. Now we have covered all liability side items. Let's move on to asset. Fixed assets, computer and printer, 50,000, 10,000. We have taken 50,000 and 10,000 for computer and printer. Since we have not yet used the full service for rupees 40,000, so that is asset for us. So we have taken shop print advance. So Slim Mobile LLP is a debtor for us. Sundry debtors 25,000 recorded. We haven't used cash, so the balance 10,000 will be same as on the balance sheet date, that is 10,000. Cash in hand rupees 10,000. And this is the final balance of cash at bank after all transactions through bank. So we have covered cash at bank. We have covered everything from the trial balance. The inventory was not there in trial balance. Where did we get this inventory from? If you remember, we have calculated the closing stock. This is the inventory with us as on the balance sheet date. Closing stock in trading account reflects opening stock, purchase and sales. Closing stock is equal to opening stock plus purchase minus cost of goods sold. Cost of goods sold is nothing but sales minus gross profit. So we take inventory directly from trading account. Always in accounting, total debit and total credit should always match. This is what we call tallying the balance sheet. So friends, with this video, we have completed the balance sheet chapter successfully. In the next video, we are going to start CA Intermediate Advanced Accounting, that is full accounting standards. I will try to cover it in both English and Kannada. If you want concept clarity and easy language, then don't miss the upcoming videos. Like, share, subscribe and comment below if you have any doubts. Thanks for watching. See you in the next video.